Hi, I'm Mike Richter, and today we're going to evaluate whether or not a property is a good fit for a rental property. I often get questions about how can you tell whether a rental property is a good investment or not. So today we're going to be using what I call the four-square analysis method to take a look at whether or not a rental property is worthwhile. For the purposes of today's video, we're going to be looking at this house. Right here, it was built in 1929. It recently had a price reduction. It's only been on the market for about 3 weeks. And the touches that are inside indicate to me that it is a flip property. So let's go ahead and expand the pictures so that I can show you around. So front, nice stonework, good replacement windows. Here's the living room. As you can see on the ceiling, there is an air conditioning intake and an outflow. And on the wall, you can see the thermostat, which indicates that even though this is an older house, it's been retrofitted to have central electric air. Now, the listing also says that it has gas central heat. So that's something to be aware of. Okay, that's more of the living room. See a nice little pass-through. Here's a galley-style kitchen. Here's the confirmation of gas. We've got a gas stove here. Right. Looks like a little addition area built onto the outside of the back of the house. We would have to double check to see whether the air conditioning unit that they used is sufficient to heat and cool all of the additional square footage that the addition had put in, which is a common issue in my market area where people convert a garage or something like that, but they don't update the air conditioning unit to account for the additional space. Here's a bedroom with a bathroom in it. Here's the inside of the bathroom. Another bedroom with cable wiring sticking out of the wall. Here's a two-car carport. We can see the back door to the addition that was built on, in addition to a little bit of storage right over there. And here's a view of the back of the house with a side exit. All right, so that's all of the listing pictures for the house. The list price is $79,000. So that's the number we're going to be using as our initial look for a purchase price. So we've got this handy dandy spreadsheet here. I'll be including this spreadsheet in a link down below in the description box. So if you'd like to have a copy of this, by all means, go ahead and access the share link and download a copy for yourself. So I mentioned that this is called the four-square method of analysis. And the reason why is there are four rectangles. I call it Foursquare because I had a lot of fun playing Foursquare in elementary school. Had a lot of fun just bashing those big pink rubber balls as high as I could, hoping that my opponents couldn't go ahead and get them. So that's a little background on that. So the first square in the Foursquare method is income. Now in the spreadsheet, I've indicated income from rent, as well as storage, laundry, and miscellaneous. That way, you could use this spreadsheet not only for single-family residences, but for small multifamily units that do not require overly sophisticated modeling to keep track of all of the income. So as we see here, I've estimated the rent at $825. Now, I'm very conservative when I'm underwriting a deal. I know that in my market, this house could get $850 to $900 rather easily with very little turnover time. But for the purposes of underwriting a deal as conservatively as possible to minimize my risk, I make sure to underestimate the rent on purpose. So $825 is the total income that we're going to underwrite for this deal. Next, we'll move on to expenses. So we've got property tax and insurance, which are included in your mortgage payment, but The reason why they're listed as separate line items is they are operating expenses that would still exist even if you did not have a mortgage and you purchased this property cash. Let's see, next we have utilities. In my market area, a house like this, I would expect the tenants to pay the utilities. HOA, there is no homeowners association for this property. Next we've got lawn and snow. In my market area for something like this, I would expect the tenants to take care of the lawn. However, if this was more of an executive rental where it's higher end property with higher end tenants, I would offer lawn care as a service, but then I would include the cost as a pass-through cost in the rent. I set aside $50 a month for repairs. So that's things like, oh, the toilet doesn't flush right and you need to call in a service call or things like that. Not major replacement of things like a water heater or a fence. That's what the next category is for. Capital expenditures or CapEx. That's a deposit account that I have for my properties that I just put a part of every month's rent into. That way, when something big comes up, I'm not so stressed out and so shocked when it comes. I've already prepared for it and I'm ready to execute and not put any of my properties or my family's financial situation at risk. Next, we've got vacancy. So the vacancy rate in my market area is a little less than 10%, but I'm conservative and I put about 10% of the gross rent into vacancy. That way, if for whatever reason one of my properties is vacant for more than a month, which is rather rare for me, that my interests are covered and I never have to worry about whether or not the mortgage is going to be paid. Next, I've got my property management fee, which in my market area runs about 10%. So I'm allocating about 10% for management fees. And next, the mortgage based on a $79,000 purchase price with 25% down. So that comes to $19,750 for a down payment for a 30 years fixed rate mortgage at 4.5%. My principal and interest portion of the payment would be $300. So adding all of those up, I have a total expense amount of $735. So we've gone over the income square and the expense square. Now that we have both of these done, now we can look at the third square, cash flow. This is where we can see the health of the property as a month-over-month cash flow property. So we have our income, excuse me, and our expenses from the previous two blocks. You subtract your expenses from your income, and we end up with $90 for a monthly cash flow. To get our annual cash flow, we simply multiply that monthly cash flow by 12 to get the annual cash flow. Next, we'll look at the cash on cash return. This is how we can evaluate how good a deal is based on how much cash am I expecting to get every year for the investment that I've placed into the property. Now, to get cash on cash return, we first have to know all of the money that we pay out for the property, which is not only the down payment, but it also includes closing costs and any repairs that you have to make to the property before it can get market rent. So in this case, we've got our down payment of $19,750. I estimated closing costs to be $2,400. My repairs on the property, even though it looks very nice, it is not equipped to be a rental property and does not conform with the state of Texas property code for rental property. So I know I'm going to have to be putting at least $500 into making it comply with the property code. And I'm sure there's going to be miscellaneous repairs that I will need to be making on the property as well. And if not, great, that adjusts my number. But for the purposes of underwriting, I want to be conservative. So that makes my total cost to close and gain possession of the property $23,000 or $23,150. And if my annual cash flow is 1,080. I take my annual cash flow and divide it by my cost to close. That's how I get my cash on cash return. That tells me the amount of cash I'm getting every year based on how much I paid for it. So the resulting cash on cash return, assuming the circumstances that I put it in and that I paid full retail price for this property, is 4.67%. Now, 4.67% is the number that you can use to compare it to other investment vehicles that you have available to you. If you can consistently get a 5% return guaranteed, or at least reasonably guaranteed against loss from the stock market or some other investment vehicle, it would be better to go into that as opposed to this rental property deal at list price. Now remember, I touch on this at list price so much because the number one thing you need to remember as a real estate investor is always purchase at a discount. Never purchase for retail price. And the reason why is you get numbers like this, 4.67%. I really would not look at anything that gives me a cash on cash return of less than 8%. That's just my standard for real estate. There are always going to be better deals. Now let's take a look at something else that's interesting here. There's the day one calculator that I've also put into the spreadsheet. This tells me what my instant return is for gaining possession of the property. So we're going to assume that the property is worth what they're selling it for. Our purchase price is $79,000 in this example. Our total cost to close, as calculated above, was $23,150. Our down payment was $19,750. The loan is the difference between the purchase price and the down payment, which is $59,250. So our day one equity, what we own versus what we owe, is equal to our down payment. But we paid more than the down payment to get a hold of this property. In fact, we paid $3,400 in closing costs. So if we were to take a look at our day one return of negative $3,400, which was the transaction fees and the repairs associated with getting this piece of real estate at retail price, we see that if we compare this day one return to our cost to close, our return on this investment of $23,150 was negative 14.69% the day we purchased it. So another way to look at it is how many years of annual cash flow would it take for you to make up the transaction costs? Now, based on the cash on cash return that we have here, it would take a little over 3 years for us to make up our initial return that we took on this. So that's something remarkable. And once again, a reason why we do not purchase at retail. So I went ahead and ran the numbers based on a 15% discount. I normally look for a 15 to 20% discount or more if I can get it on any property that I purchase. So let's assume that our new purchase price is $67,000, which is about a 15% discount. So then our new down payment of 25% of our purchase price is going to be $16,750. We'll assume closing costs for repairs are about the same. Because our mortgage is on a lower loan balance, I went ahead and recalculated that. Our new mortgage principal and interest payment is $250 a month. So that does quite a few things to our scenario in the Foursquare analysis. Our income stayed the same because we're not assuming the income is going to increase just because we bought the place at a discount. But what did happen is our mortgage expense went down. So because it went down by $50, our cash flow every month increased by $50. So we're looking at a cash flow of $140 per month, which is an annual cash flow of $1,680. Significantly better than the other scenario. Of course, we bought it at a discount. Now let's take a look at our cash on cash numbers. Because our down payment was lower, that lowered our total cost to close. And also, because we have a larger annual cash flow, this would naturally create higher cash on cash return. Now it returns higher than 8% cash on cash, and I'd be happy with that. And the reason why I'd be happy with that is because of what I'm going to show you next. Let's scroll down to the day one calculator on this. Well, if the property is still worth $79,000, like we assume it is, and the purchase price is $67,000, reflecting a 15% discount, our cost to close, we already calculated that as $20,150. Our down payment is still $16,750. Our loan amount is now only $50,250. Our day one equity, what we own, this $79,000 house, minus what we owe, this $50,000 loan, our day one equity is now $28,750. That's remarkable. Because of the $13,000 discount that we achieved, now this, instead of being a $3,400 negative return, now we have an $8,600 positive return. So the day we close on this property, we put $8,600 onto our net worth on that day. Now, if we take $8,600 and divide it by 20,150, we would see that the instant return on this 20,150 is a whopping 42.68%. So, if I could get this property and it performs as intended with these conservative numbers, then we have hit not just a single, but probably more like a double or a triple. Because once again, this income number is conservative, so I would be more likely to get closer to $900 in rent, which increases all of our positive numbers. In addition to that, something else to keep in mind is a part of your mortgage is principal. That's paying your loan down. So that means that principal portion of your payment is increasing your equity, thus increasing your total return on your investment. Another piece to this puzzle is that every year, houses tend to appreciate by about 3% on average nationwide. So if that appreciation were to happen at that assumed 3% rate, that's another 3% return on the original $79,000, not on my original cost to close of $20,150. So that's closer to a 9% return on investment just through appreciation, because I'm using the concept of leverage, where I'm taking a loan out on the property to purchase the property and only have to put about a quarter of the total purchase price down, which is why leverage is so important in real estate, because it multiplies your gains when you underwrite conservatively. It rewards those that get the better deals. So now that we take a look at all of these numbers, I may look at going to see this property, and in a couple of weeks, provided that it's still on the market, I'd be looking to make my initial offer requesting a 20% discount, and we'll see how that goes. However, based on the fact that I believe that this is a flip and there is a significant amount of money being tied up in the property, I doubt that the seller is willing to let it go for a 20% discount. But we'll see what they're willing to play with, or if they're willing to play at all. I would imagine that they're really looking more for a retail buyer than for an investor to buy. So, to recap, we went ahead and analyzed this property, both based on a purchase price of $79,000 and based on a discount of 15%. So a different set of numbers based on a purchase price of $67,000. And we saw just how powerful purchasing property at a discount actually is, and how you get instant return on your investment day one, and it multiplies your cash on cash returns as well as your other forms of return in the property, which is why the number one rule in real estate investing is you always purchase at a discount. Then we went through the Foursquare method of analysis, where we looked at all of the income, all of the associated expenses, subtracted the expenses from the income to come up with cash flow, and we took the cash flow and divided it by all of the costs needed to actually take possession of the property and make it into a rental property. And then we looked at day one calculations, but in both scenarios, the $79,000 purchase and the $67,000 purchase, to see how radical of a difference that little 15% discount makes. So, if you found great value in this video, please go ahead and give it a thumbs up. If you have any questions, go ahead and put them in the comment section down below. Once again, I'm going to have this spreadsheet put down into the description box so that you can download a copy at your leisure. If you feel that you've gotten great value from this, by all means, go ahead and hit the subscribe button. And if you'd like to see notifications every time a video comes up, because there is so much value here, by all means, next to the subscribe button, there's a bell that has your notification settings. And go ahead and set your notification settings to what you deem is right for you. If you've got friends that you feel could benefit from this, by all means, go ahead and share. I love to go ahead and share what I know so that I can help other people attain great things in their life, because I know that I've had great many blessings from having great people in my life teach me the ropes to help me get to where I'm at. So, this is about the time in the video where I ask you to have a fantastic day.